Let's see. Alrighty. Just waiting for folk to join us. Mm-mm-mm.
Real nice in the background.
We'll give people about a minute or so we can be
Does it record it
respectful
though?
of Mr. Say it again.
Is it recording so we can have it for later?
Uh-huh. Yeah, yeah. Yep, it's recording.
Hope so.
Your signal is not as strong, but
It's like a
it's working.
it is okay.
Yeah, a little blurry.
A little blur. Um,
It's alright. It's alright. You know, I don't know why it's not so strong. Is that your internet or you logging in from
I just go
your
straight to the
phone?
desktop. Oh no, this is on the
Oh,
desktop.
okay.
Yeah.
Cool. Alrighty, we'll start in a couple minutes. I'm getting a lot of feedback from your end.
Oh, feedback on it.
I hear it coming back to me. Did you cut your cell phone off?
Oh, hold up. Let me.
Is that what it was?
What about
Make
now?
sure you cut your cell phone off.
Can you
It
still hear
sounds
it?
better. Okay. Nope, I can't hear it.
Okay, yeah, we should
Awesome.
fine.
All right, we about to get this thing started. Just trying to make sure it's showing up in the group.
So, are you able to take it off live and then do it, or you have to wait?
Oh no, no. I mean, it's fine. It's just I gotta. I still getting a lot of feedback from your end.
Give me
It's so
1 second.
weird.
I'm about to do something. One more. Let's do.
Okay.
Oh, okay. Hold up. Let me know. Audio output, microphone. Yeah, it should just be. But I'm gonna do this one.
Are we good?
That's probably why. Let
It
me
looks
see.
good.
Smart.
Yeah, it's like
Oh,
really slow.
what?
All right. Well, you
What
go
about
ahead and
now?
work on your text side. It looks good. It looks good now.
Oh no, can you hear me better?
I can hear you. Yep, yep. It's not throwing
Okay.
feedback at me.
Okay.
All right, just cut your volume up. Did you cut your volume down?
Uh, let's see.
Alrighty. Well, we're gonna go ahead and get started. We're gonna get started. Get started.
Oh, sure.
So I see people coming into the room. Please share this on our Facebook page if you can. Um, we will be making this available as a recording in our YouTube page. So you will be able to share this out with your bison later. Um, and so without further ado, we'll go ahead and get started. It is 4:33. I was just checking to see why it wasn't showing up um, live in the. Hold on 1 second. Oh yeah, no. Okay. Showing up live in the actual event page. But either way, we got some people in here, so they're coming from somewhere. Um,
And let me. I just changed the microphone again. Is it a little bit louder?
oh, that sounds. Yeah, it's better. It's better.
Okay. Awesome.
Hmm. All right. So we just wanted to give people some time to come in. I know this is not always a good time for everybody. Folks are just getting off work and doing their thing, and getting their kids settled and getting themselves settled. But I just wanted to once again bring in front of you another professional that will offer some insight around a topic that may be of interest to you and that could support your bison throughout their journey while they're on campus and then post their collegiate experience. And so we want to thank all of you who are watching right now and those of you who will be watching this later for joining us. I did send out a flyer to give you a little bit of background information about what we're going to be talking about. And so, if you haven't noticed already, this is actually my son. This is my son, and he is a branch financial manager as well as a small business consultant for Bank of America. And so I figure what better person to come and join us to talk about issues regarding finances and decision makings of our young people than my young person. Who happens to also straddle two financial education businesses. And so, welcome, Craig Hairston Green, to our
Thank
live
you.
chat with our parents. So what we're going to start off with is just asking about your decision to get into the banking industry. What made you decide to go into the banking industry?
Yeah, honestly, so for me, it was pretty much by mistake. I was at high school. It's my last year, 12th grade year. I was able to do a co-op to where I believe my last two classes I didn't have to actually go to. Well, I had to, but they said if you don't want to do these last two, then you have to start working. I just happened to get a check, I think from McDonald's or the ice cream store I used to work at.
Hmm.
So I walked into a bank and went to go and cash my check. And one of my classmates were there, and I'm thinking this girl don't got a diploma yet, no degree. How is she able to work into a bank? And to be honest, that might have been 11th grade. So I went back to her
Hmm.
that same day, and I was like, "What exactly did you do to get into this field?" And she was just a teller at this time, and she was like, "Just apply for it." This would have been downtown Harrisburg on Second Street, and I applied. They were paying, I think, $9 at that time, so it was much better than
Hmm.
most other companies. So I thought I had money at that point, and I liked it because it wasn't hard labor. I wasn't putting in too much effort, physically. It was more of a mental job and just relationship building, even from the teller side. And also just growing up in the environment, from my high school neighborhood, family and friends, and seeing people at that time struggle with money and being around money and being able to help others at such a young age was like it kind of pumped me up a bit, so that's how it started, to be completely honest. And I worked it out. Uh, I wasn't really looking to move into a promotion at that time because I was going to be going to college pretty soon, but it literally just popped up and I seen that there was some potential there and I grabbed onto it. Mhm. Oh, your microphone's out.
Sorry. Okay.
There you
So talk to me a
go.
little bit about that because you probably want to mute yours. So when yeah, it's because you get feedback if it's not muted. Um, because I remember when you were in your senior year, you was preparing for college and you was like struggling trying to decide what you want to do. And then, in your senior year, you like last couple semesters, like, oh man, I wasted some time. I didn't figure out what I wanted to do when I grew up. And now I got to graduate. And I kept saying, well, what do you love? What do you love the most? And you was like, money. I like money. And I'm like, all right, let's start there. You like money. What about money do you like? So that was an interesting kind of connector. And then, finding your way to the banking industry. What are some things that you wish you were exposed to more as you were becoming a college student in regards to your finances that you wish you were better educated on?
So 1 second. Okay, there we go. Well, yeah. So one of the biggest things, and I'm sure you even knew at that time because we used to share a joint account, was the fact that going into the overdraft a lot. always overdrafting, asking you for more money. Can you send me money? Can you send me money? Um, and that's also part of the reason why I was so ambitious in the banking industry, and till this day, because I was like, I can't keep asking my mom for money. This isn't fair to her. So I think at that point, even though you taught me about it, it was just I didn't grasp on budgeting your money, um, putting your needs before your wants, and still being able to live comfortably at the same time, and still do the same things as your friends are doing, but not overdoing it. Realizing what's necessary and what's not. I remember a time where before the bank, I was working at McDonald's and I would get my little $120 check. I would go straight to Sneaker Villa, get some shoes, an outfit, money gone. And then now I'm asking my parents, for $20 to go out to the party and things like that. So the biggest thing, at least in that area, would have been, do you actually need this, or is this just an impulse buy? Are you trying to just keep up with a trend? Or are you even thinking about what you could be doing with this money outside of, outfit, or outside of, entertainment expenses and things like that? And once I realized that, which took me a while, it made more sense. So that would be the first thing, is just budgeting funds. Second would be using your time wisely to make money as well. It's countless hours, I would say, I probably spent at home watching TV, playing video games, sleeping when I could have worked the extra shift. I could have been building on a company or something, or just saving that money. Um, so that would be the second thing. Man, I would even say credit was a big thing. So when I had my daughter, I was against credit, especially in our culture. A lot of our parents, or not parents, I would just say family in general. It's everybody's like, hey, credit cards, stay away from them. They're not good for you, things like that. And when it's only true when you're not using it in the correct way. So when I first got my credit card, it was like, okay, I'm getting it for the right reason. But after it was paid off, I was like, okay, this is an extra income, when it really wasn't. And before I knew it, I was maxing it out and things like that. So knowing how to manage credit, budget money, and let your money work for you as well, instead of feeling like the only way to make an extra dollar is to clock in and spend 8, 9 hours of your personal valuable day working for somebody else's company. And it's funny because I do now, to this day, but I take those same funds and help build my future and invest in certain things that I think is valuable, so I don't always have to do this. Mhm.
All right, it's a little delayed because we got to unmute and mute so that our sounds won't be competing with one another. So what's the importance? So you talked about, us having a joint account, which was like, parents, yeah, can you see me or hear me? Parents don't, yeah, you got to watch them accounts when you got a joint account with your kid. But, you were talking about having a joint account and just making the best decisions, and you wish that you would have paid attention to some of those lessons, but you did end up starting a checking account on your own, and so tell the audience what's the importance of opening up a checking account before the age of 18, and possibly even applying for a credit card at that young. How does that benefit them?
So I think it's probably, I wouldn't say the first big responsibility. I think most kids, their first responsibility is just remembering to take out the trash, remembering to do, clean up their bedroom and things like that. But then it's just another responsibility before 18. If your parent says, hey, look, $200 in your checking account, I want you to go to the bank, which we have kids now where their parents, they're like, I'm not going in there with you. Here's your ID. Here's your social. I want you to walk into that bank, and learn how to pick what's right for you financially, learn how to ask the right questions before you open up the account and things like that. Um, definitely before 18, opening up a checking account, it almost forces you to learn finances much quicker, because even if it is your parents' money or it's your money, you're like, I don't want to spend it all, because when you see that balance go lower and lower and lower, you start to reevaluate everything. And you're making more phone calls, or more phone calls are coming in. Hey, you want to do this, or you want to do that, or you may see something you like and you load up that Bank of America app, or Metro Bank at that time, and you're like, I can wait on it. So it teaches you discipline when you're younger, because even me, when I was younger, you would go to an ATM and I would literally think that that was just this machine that was spitting out free money all day. And it wasn't until I got an account, and man, there would be days I would wake up and be like, where did my $100 go? I only got 20 now. So it showed me to be mindful of my finances, um, and just being disciplined. I think sometimes when we get money into our account and we know it's a nice amount, we love to not look at it. We don't look at it until we get an alert from the bank, or you get an overdraft fee or things like that. And now all of a sudden we in there trying to analyze it, and we want to run to the bank and figure out what happened, when we know what happened. We overspent. So getting it at a young age is just, it exposes you. It kind of forces you to say, look, this is what I have to spend. And this is what I want, this is what I need. How can I balance this out? So little things like, at that time, my cell phone, make sure my cell phone bill was paid. But hey, I want to hang out with friends too. Or even on a bigger spectrum, hey, I want to take this trip, but I'm about to start my first year in college, and I want to make sure that I have the right book. So I think for kids under 18, especially about to go into college, it makes them look at things a little bit different, opposed to if you're just saying, hey, here's $100 or 200 to your kid. You're not putting it in their account, their checking account, to where they can check it, they can get alerts on it, they can feel what it feels like to get an overdraft fee a couple times. When you're just doing that, you're just this never ending giving, as far as money goes. You just keep giving and giving, and they're just like, whatever, I blew it. And I think it's easier to justify overspending when you can't look back on a statement and say, okay, no, that was me, that was me, that was me. You can just kind of in your head be like, I'm sure I did something right with it. So yeah, definitely before that age. Also just security, because when you're that young and you have a checking account with the debit card on it, you have to realize you have to keep that on you at all times. You have to watch what websites you're making purchases from, gas stations, grocery stores, things like that, because at least in 2021, as far as scams go, it's really bad, especially in Houston. So if you're a little bit younger, when you take that first step with having that first checking account, um, it'll just protect you in the future. I actually had a client a couple weeks ago, came into the branch, and somebody told her that her husband was in jail, and she ran to the bank, or not to the bank, to Walmart, got a whole bunch of gift cards and transferred about $1,500 out to get her husband out of jail. Don't know why she didn't just call him. But yeah, just little things like that is when you're younger, and you learn about finances, about your security around that. When you hit that 20-year mark, 30 years old, things like that, when it comes to your privacy and security, you're much more stronger. It also helps you with saving, which is a big thing. Most people in America don't have enough money to save, or don't have enough money for 3 months. If they don't get a check this Friday, they're probably going to get evicted. Car note's not going to get paid. Credit card's not going to get paid. And that's a lot of people. And that just goes all back to having that account and learning how to save, to prepare before it's needed. I think sometimes we wait until we don't have the money. Now we're running for the quick cash loans, and we quick to ask friends or sell something, or now we want to find a quick hustle to make some money, when 2-3 months ago, that extra income tax you got or stimulus check you got, you could have saved, and you would have been prepared. there's so many different dynamics with having a checking account early. But those are just some of the key ones. Um, and it's just it felt good at that age to have one. You know, most of my friends will have to go and cash their check online, or not online, but cash it at the bank. Where I would wake up Friday morning and the money is there. You know, so
Mhm.
I have to
Mhm.
pay those check fees and things like that that other people would have to pay.
Okay. So, what do you think? First of all, because we know that even giving accounts to young people who are minors, like they still have to have like those little money market accounts and things like that, that still has to be monitored by their parents, but it still gives them a sense of ownership because they get to see the statements, they get to see the money leaving and coming in, you know. And things like that. But you mentioned, how it kind of built a sense of responsibility for you. You talked a little bit about just, just paying attention to it, right? You kind of you're absent of thoughts when it's just cash in your hand, but when you can actually see, the differences and then have to deal with the penalty of, oh, overdraft. Okay, so that's an additional $35, and you didn't have $35 in there in the first place. But you also talked about 4 years of credit, history. Like, so before you even go into college, you're establishing, if you get a credit card in your freshman year, although we try to encourage our kids not to apply for those credit cards because those banks come into the little, the campus and try to get everybody to get a credit card, and parents is like, nah, don't do that, don't apply for those credit cards, don't do that. But what you're saying is that if they did and it's monitored over 4 years, at least when they graduate from college, they have credit established, they have history established. As opposed to not. So what would be the better practice in terms of getting that credit card? Like not just any credit card. Would you recommend like just banks that your parents are, and credit unions? Like what would be your recommendation for that? Your mute is on.
Um, I have to charge the laptop. Let me plug it in really quick for you guys. Be right back. 1 second.
This is classic, y'all. For all of you who's watching, that's my son. He's he's so classic. Give him 30 seconds. He'll be back.
All right, everybody, I'm back. Just so everybody knows, I left work, ran here, and was excited to do this interview. So I'm coming straight out of work. Um, bear with me. 1 second. Okay, sorry about that. This is reality
Alrighty.
here. This is not. We ain't faking. This is.
That's real.
There ain't no script. No. Should have been had this charge. Um, but yeah. So as far as yeah, I tell parents every day. So they'll come into my office, and I try to take the approach anytime I'm offering products to kids, services, or anything like that. I want to come from a genuine perspective. And the parents are always down for the checking account, the savings account, online banking. But the moment that I bring up credit cards, it's like their face turns blue. They're like sweating, and they're like, no, 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 I don't think they're ready and things like that. And this just it pretty much goes back to credit is only bad when it's not utilized the right way. Um, and like you said, the whole 4 year idea that I came up with, and I preach this to my clients and their students, is that this is a moment where they are now 18, that they can get a credit card, which you can't get one before then. You can be a co-signer on it, but not every bank reports it to that child's credit at that time. So when you're 18, you finally have that marker. Not only are you 18 and about to go to college, or maybe you're just working, but let's say you're going to college, that's 4 years that you probably don't have to worry about bills. You don't have a lot of financial responsibilities. Hopefully, your family is supportive enough where you don't have to worry about taking care of them while you're in school. You can just focus on your finances. But regardless, everybody's situation is different. Some people decide, hey, I'll just start working extra hours and balancing my school. But I say all that because those 4 years are normally, you have no bills, no debt. Your parents are stressed about your student loans, but not you. So it's a great time to open up a credit card. And even if you don't feel like your child's ready for it, you can open it up when they're 18. They can be a co-signer at that point. You can set a credit limit on it. So they can only spend $100, 200 or 300. Um, and the benefit of this is that after those 4 years are done, now they have 4 years of credit history. Most auto loans, home loans, even some credit cards, the minimum is 3 years of credit history. We have people graduating with PhDs, literally doctors right now, coming to the bank and never had a credit card in their life. Now, obviously, it takes them longer to graduate, but they don't understand how credit works. Now they got to spend 4 years and they got real bills now. They got real auto loans and things like that, so it's a little bit harder for them. So the whole idea by starting it the moment you get into your 4 year college is that once you're done, you have 4 years of strong credit. You've learned how to build credit. When you get out of school, I don't know about how many parents out there are, wishing their kids are going to move back in or can't wait for the kid to ask for some money or to drive their cars. So you kind of got to expect when you get out, your parent might be like, you ain't come back here. So you need that credit to get that apartment, that auto loan. You need credit if you want to go into your master's degree and take out another student loan. So it's very smart to do it before you have other bills and you have to make decisions between, am I going to pay rent or am I going to pay a credit card? When you're in school, it's, I just need to get A's and let me just pay this little $10, $25 payment a month, because the credit bureaus do not care how much you pay. You can pay $1 million on your credit card or you can pay 10. As far as payments go, it shows as a payment on time. So if you have 4 years of that, your score will be great. You're learning that discipline, and you're pretty much stepping out in the real world. I think the last thing you should have to stress or worry about is finances at that point. It should be, where am I going with this degree? What is my next step? It sucks to have to think about all those same things, and you're getting late notices and you're getting overdraft fees, or you're not getting any of that. You can't get a car loan with a decent rate because they'll easily give you a 10% rate on your car because you don't have any experience with it. I've had
10%, 13%, 14%, 15%.
They'll push it up,
Yes.
and a lot of the times they'll do that because we're so quick. It's very easy to go into a dealership and just get a car, but what people don't understand is that they got to make money too. So they'll just slap a higher interest rate on top of that. They'll still send a loan to Bank of America, to Wells Fargo, or whatever the case may be. But they'll give you a little bit of a higher interest rate to where you could have just came straight into the bank and got a better one. But that's kind of a side note. But nonetheless, building that strong credit score in those first 4 years out of high school helps you get lower rates. You get a higher credit limit. And when you have lower rates, you pretty much stay away, as long as you're paying it on time or paying it off, you stay away from that cycle of you're making a $30 payment, but then you get $50 in interest charge. You'll never pay that credit card over. And that pretty much all goes to play on having credit history being built up, on your credit score.
Awesome. So I did have a couple questions that is popping up in the chat. One of the parents, and I think we already alluded to this, asked, is it a good idea that we as parents manage our kids' account or make them responsible for it? And I think we talked a little bit about, having an account where you're monitoring your kids' money for a period of time. What is your thoughts around that?
Yeah, so I would say, and a lot of people don't know, I'll be honest, I just found this out because of my role is kind of getting more diverse as far as my tasks. But we're now opening up accounts for 10-year-olds, 11-year-olds, 12-year-olds, checking accounts. They're getting debit cards. They can't get online banking yet. Um, at that age, you definitely want to stay co-owner. Um, Let them have that account, but be a co-owner so you can check what they're doing, check how much they're spending. Um, some of the biggest mistakes I see, if parents allow the kids to have the accounts just by themselves, is that at that age they're spending and they don't understand that it takes a day or two for some transactions to post. So you may think that you have extra $100 and you don't, um, but the bank will still authorize it. And once it all finally goes through, a few days later, now you're in a negative. I think once you hit that 17, around 17 years old, still stay on the account with them, but just give them a little bit more control because they do have to make their own mistakes with it. Because if you keep, I've seen it where a kid will go into overdraft and the parent comes in and either deposits money in the account or begs for the overdraft back, and the kid has no clue. So you still want to be aware of it, but kind of just allow them to experience it on their own. Because it's not until they get that fee and you're like, I ain't giving it back to you. Now it's a whole different story. They're going to spend a little different. And it does get to a point, let's be honest, after 17, nobody wants their parents to know what's going on in their accounts. So I think that's why it's smart if you start young with your children. Once they get to that age, it's easier to let go. But if you start when they're 18, it's like, I just want to help you. And they're like, I don't want you to know what I'm doing, with this money and me and my friends and stuff like that. So, but that's not the parents' concern either. It shouldn't be. I'm trying to help you financially. So once you do graduate, everything is good
Yeah.
to go. But I'll definitely stick by their side if it gets to the point where it's too bad they can't pay it or they're really in a hole with their finances. Help out. Always keep that monitoring over their account, um, but let them feel it a little bit. Definitely be a
Hmm.
co-owner.
Yeah, and
Mhm. Yeah, go ahead.
no, I was going to say that was kind of something that I was, that I had happen to me with my mom. She made sure that I was a co-owner of a major credit card. At the time, it was like John Wanamaker's, and I didn't know that those store credit cards were considered major credit cards, and it
Hmm.
carried the kind of the same weight as like a utility bill or something like that. And so she put me on her credit card
Hmm.
way back when it was John Wanamaker's department store. In fact, I still have that same credit card to this day because ownership changed. It became Hess's and then it became Macy's. And so since I was 16, and so my credit was established by the time, I was, 19 years old, and I was able to buy a brand new car, low interest rate. But some of the parents was asking the question as well, putting the kid on your credit card, and how does that like really reflecting on how that um, builds the credit, because you're going to pay your credit card, right? This is my credit card. I'm going to pay it. I'm going to pay it on time. I'm going to keep it below 50% of the balance that I owe on that. And then that helps to strengthen your child's credit. The
Hmm.
opposite has happened though also, is that parents use their kids' credit to purchase
Run up stuff.
things, and the
Yep.
the kids never know until they're about to graduate from college and they're trying to get their first apartment, and now they discover they got bad credit history because someone opened up a utility bill. And
Yep.
then how do and you find out it's your mother. Well, what you gonna do?
Yeah.
Like
Nothing.
what can you do about that?
Well, I mean, and there's two. So I'm going to talk about the second part in a moment. The first part, as far as how it builds their credit. Now, let's say that you do, as a parent, you have strong credit. You can walk into a bank and get a credit card approved for $5,000, $10,000. The power of that is that now you can put your child on that credit card to where they would have only been able to get like a $300 credit card, which will help your credit, but not that much. And I say that because the credit bureaus look at how much credit you have available. Um, and that plays a big part. And mainly, they look at that because they say, hey, if they have a $10,000 credit card, available credit, nothing's owed on it, I feel comfortable giving them another credit card or giving them even a small mortgage because I know if they miss a payment on their mortgage, they have this credit card to fall back on, at least for one payment, opposed to having a $300 credit card or not one at all. So when you put, your child or your student on your credit, if it's strong, it's going to probably do 10 times the work opposed to them just walking into the bank by themselves. Um, at the same time, you want to make sure that they use it right because you don't want to end up having bad credit because they're not making payments or on time or they max it out and you can't afford to pay it back. Then, like you said, parents using their kids' credit to do things. And I think a lot of it starts with a honest need, but that's not what the Social Security card is for. 6-year-olds shouldn't have Xfinity in their name and things like that. And, it's unfair. What is that, 12 years later when they're 18 and they can't even open up a credit card. And I see it all the time. They'll say, hey, I don't have anything on my credit. It's perfect. And we apply. And I'm like, well, when you were about 4 years old, you took out a car loan. So, and the credit bureaus, they look, and there's nothing we can do because even as bankers, they don't allow us to know exactly the algorithm with it. So, and they do that so we can't finesse it and, work it out for the client. But it just hurts the child in the long run. It makes it harder. And the credit bureaus don't care. Like I said, they look at it like, look, your credit's bad, figure it out, come back when you have time. So for those parents out there who are like, I do got some of my kids' name, just pay it off or pay it on time. Because even if you do open it up, hey, maybe if you pay that bill on time up until they're 18, it'll benefit them. And maybe I think some parents, that's their first idea, but then they realize I can't pay this, which is the reason why they're using their kids' credit. And it's just this never ending story. So if it ever comes to the point, I feel like the only time you should be doing that is when you're trying to build credit. But if you're in that situation where um, your kid is your Xfinity bill is coming up on your statements, just make sure you pay it off. Because it's going to hurt them. And it sucks because that could have been the same child that once they got their finances together, they could turn around and change your financial situation because their credit was great, but now they can't because they started off with bad credit. And now they have a negative attitude against the whole financial world, because they're like, I didn't even cause this. I wasn't even, pretty much given a chance on that. So um, that will definitely hurt.
Yeah. Well, that's good. I mean, I'm glad that you brought that up. We had so many questions, parents, and we always give you some small snippets and small discussion points, and give you the opportunity to come back and join us again, or follow the speaker for more insight. But with that, you had mentioned we were talking a little bit about how parents kind of go into your credit account and sometimes because of their own bad spending habits and their own bad past negative financial history will then take out loans and establish credit under their child's name, and then don't pay it. And so they're allowing their kids to start their first years as an adult with bad credit. And so we're talking about wealth gaps and why there's such a huge gap between the haves and have-nots. Like some of that is like early exposure to financial education and just better decision making. So one of the apps that I like to use is the Credit Karma, and that helps me to kind of figure out what's going on with my money or my situation at all times. Can you share with the parents about Credit Karma and how safe it is and how does it help?
Yeah, it's funny because Credit Karma, and this is maybe a cliche, but Oprah is the first person I know to talk about it. And this is about, I would say 5 years ago, maybe, or more. But I remember her, I was like, hold up, but this is on her show. It must be something that's really strong. And this is before a lot of people knew about it. But it's literally an app that you sign up for free. It's gotten way more secure over the years. So you pretty much go in just as if you were just trying to get a free credit report. You would fill it out. They're going to ask you security questions, a bunch of them. they might even ask you a question like, hey, where were you living at in 2010 in July? And if you don't know the answer, you can't get approved. So, and I say that because it's very secure. But the app also takes in all three credit bureaus, TransUnion, Experian, and Equifax, and it pretty much shows you all of them and how the how your score moves on a daily basis. TransUnion, they're a little bit easier going, so you'll notice your score is much higher on this free app. And then I believe Experian is the most stringent. Like they don't play. You miss one payment by a day, they're going to hit your credit. But the great thing about Credit Karma is that it keeps you up to date. It'll even remind you of when your payments are due. It'll tell you immediately if there's a missed payment. You can dispute your anything that's negative. A lot of the times we go out to these third-party companies or just companies in general and ask them to dispute medical bills or things that shouldn't be on our credit report, and we end up paying hundreds and hundreds of dollars when you can just go on Credit Karma, select the accounts that you don't believe is yours or you don't believe that you should have to pay back. And they'll have options for you to pick on, hey, look, this medical bill was given to me, but it was never disclosed on how much. And I've noticed a lot of clients that I have at my bank, it's a lot of medical bills. And they're like, I went in, I got fixed up, they sent me home. They didn't send me, I didn't even know about a bill until it was in, collections. So Credit Karma just says, hey, look, come here, tell us what doesn't look right, submit this. And if that company can't prove that it's your debt, which most medical bills I've noticed they can't, it just drops off your score. It drops off your credit report. Um, and now that's one part of it, but those collection accounts are a big thing because when you go for, let's say, an auto loan, you go for a mortgage, they don't care necessarily all the time how much the collections is. It's the fact that you have one. I had one lady, she had like $1 left on her credit card. She thought she paid off because it said it was an unpaid credit card bill, declined, for the credit card. And that's just not where working at now. That's all three banks because I worked about two other banks previous to this. So it's universal. So Credit Karma is very good for those default accounts. Also, it'll show you on there. A lot of people don't even know, I guess, the FICO scores or credit scores. The people behind it kind of keep it in secret. But when you look at if you break down your credit score, 35% of that number is based on your payment history. Credit Karma
Mhm.
breaks that down for you. The other 30% of that score is based on how much you have owed. That's just sitting there
Mhm.
because the balance sitting there is a
Mhm.
risk. You could just wake up one day and say, I don't want to pay it anymore. Now that company
Mhm.
has to take on your debt. 10% of that score is new credit. So if you open up a new credit card, as long as you're paying it on time and things like that, it's normally a good sign for your score. It'll definitely help it because now you have more credit utilization. Um, Opposed to if you have a $5,000 credit card and you're using 4,000 of it, you're over that 30% mark, which is a big thing. You want to stay below. If you have 10,000 in available
Mhm.
credit, try to keep it below 30%, which would be 3,000. Um, the other 10% of that score is types of credit that's in use. So Macy's, I don't. Is Boscov's even around anymore? I don't know, but that.
No, I don't think so.
So those like retail, they're not as strong as bank credit cards. I think it's because it's a limit on what you can use it for. So you can't use it in emergencies. You can only use it at this store, and it normally comes with high rates. And I'm just throwing this out there. Maybe they assume if you have a whole bunch of Macy cards or Boscovs, you have a spending problem. So I've
Mhm. Mhm.
heard, I can't say it's a fact, but retail cards aren't as good for your credit as bank cards. And then the
Mhm.
last 15% is going to be length of credit history, which goes back to starting young. Um, we have even at where I work now, you can come in. They don't care if your company is making $1 million a year in revenue. If you haven't been in business for at least 2 years, some part of that I believe is at least 3 years for other companies. As far as your credit goes, they won't approve you for anything. So even if you
Mm-hmm.
get a credit card today and you got an 800 score, they can still decline you because you've only had it for a day or two. So
Mm-hmm.
and that's the
Mm-hmm.
breakdown.
Well, that's good information. And I remember you telling me to get Credit Karma, and old school folks, like we don't really like giving out, like having too many things have access to our information. And one of the things that I noticed with Credit Karma is that if you want a one-stop spot to see where all of your bills are, to see where all of your debt and all of your loans, you can kind of use Credit Karma to have all of that stuff in one place.
Hmm.
Um, and actually, you can pay your bills off of the Credit Karma, like right then and there, and then set spending goals. And when you are a little off kilter with your spending goals, it will give you an alert like, yo, like, yeah, I noticed you've been to Starbucks four times this week. Like, that's against your, your plan. But you're right. It will give you some alerts. It's one place where everything is at, and I can visually see it. It gives me a bit of a scale, like a pie chart. Like you spending
Yeah.
a lot of money on entertainment, versus your utility bills.
Mhm. And it'll also show you one thing I love about it is that a lot of the times when we're trying to build credit, we don't know what to apply for. If your credit's not strong, you don't want to try to apply for American Express. That just doesn't make sense. That's a really you have to have almost excellent credit to get approved for that. So Credit Karma sits there and they'll say, hey, this is what we have. These are the cards that we think you'll get approved for, and then it'll list it by excellent odds, good odds, or bad odds. So you're not out there doing a million applications because every time you get declined for a card or any type of loan, it does hurt your score a little bit. You may not notice it at first, but that over and over again, it takes a toll on it. So Credit Karma says, hey, look, we already looked at your credit. We looked at these companies where we know their trend and their history for approval. These are the cards that you should do. And this is all free. I've used it for 8 years and I've never paid a dime for it. It's amazing. There's no advertisements on it. There's no like in-app purchases. I don't know. So they have some connections with the financial world, but it's amazing. Right now, I think they have like over 1 million ratings and pretty much everybody uses it. And then within that, it also gives you credit tips. So it'll say you can literally use a calculator and say, hey, if I pay off this credit card $100, how will this help my credit? And it'll give you like an example, like a bit of a simulator. And that's all on there. When my clients get declined, I let them know. I'm like, hey, this is not a product of my company, but personally for me, this is something that I use. I would go home, review it, make sure everything is accurate, and if it's not, dispute it. And also look at the tips that you can do to help better your score. Another thing is the secure credit cards. If your credit's not that strong, you can literally walk into most banks like Bank of America and you can say, hey, I want to put down this certain amount of money. It could be like $300. And you have pretty good odds of being approved. It's not always 100%, but you still have that option. And if you do good with that card for a while, eventually the bank gives you back your money and then they increase your credit score or your credit limit, which will increase your credit score. And one last thing with the secure card, a lot of people think, oh, it's secured. It's not as good as a regular unsecured. As far as the credit bureaus go, they don't know. So if you put $10,000 on a secure card, it looks like you just got approved for a regular unsecured. I didn't have to put nothing down. Visa, MasterCard, credit card, with any institution pretty much.
Awesome. Awesome. This has been good information. I'm hoping that the parents who was able to log in, it looked like it was a total of about 45, 50 parents that was in and out. I know y'all commuting back home and probably trying to share this information with your bison. But we want to thank you guys for signing up to join us this evening. I do want to remind you that Mr. Green will be continuing to do these live workshops. This was a little snippet of some of the work that he's doing, but encourage your kids, your bison, to follow him. I'm putting a link in the chat right now, and you can share this with your bison. Mr. Green will be facilitating a more in-depth, interactive session coming up in March. March of 2022. And it is on March the 26th, 2022. It is on a Saturday from 10 a.m. To 11 a.m. That is Central Standard Time, 10 a.m. to 11 a.m. So if you are on the East Coast, that would be 11 a.m. to noon. So definitely check out the link that I put in the bottom or in the chat, and so that you can follow Mr. Green's journey and workshops that he facilitates, more in-depth, more interactive with your young bison. Again, this is Mr. Craig Hairston Green. He is my firstborn.
Yeah.
He is the financial manager and small business consultant for Bank of America, and I am your committed administrator for the Higher Parent Connect. And we just want to thank you for joining us this evening, and hopefully you found some use of this information. If you have any questions after we log out, I'll make sure I get those questions to Mr. Green, and he'll follow up with you. I want you guys to have an amazing night.
Awesome. Woo.